Ever wondered why people invest in Apple, Coca-Cola, or Tesla, and how they're all actually different types of stocks? That's because they belong to different sectors, and understanding sectors helps you build a smarter, stronger portfolio. You know, one that's actually risk-adjusted. Let me show you how. When you invest in the stock market, you're not just picking random companies. You're choosing companies from different parts of the economy, called sectors. Think of sectors like categories in a grocery store: tech in one aisle, health in another, energy in another. Just like you don't eat only one kind of food, you shouldn't invest in only one kind of stock. Mixing sectors? That's smart investing. Now let me break down the 11 major stock sectors, but don't worry. I'll keep it beginner-friendly. First up, technology. These are companies building software, electronics, or digital platforms. Think Apple, Microsoft, Nvidia. They're super fast growing, but also more up and down, so keep that in mind. Next, healthcare. This covers medicine, hospitals, and drug development. Picture Pfizer or Johnson & Johnson, usually more stable, because people always need healthcare, right? Third, financials. That's banks, insurance, and investment firms. JP Morgan, Bank of America, Visa. They keep the money flowing. Fourth, consumer discretionary. That's basically the fun stuff we buy when we have extra cash. Toys, video games, vacations, fancy clothes, not needs, just wants. Nike, Amazon, Starbucks, all in this sector. These rise when people spend more but drop during tough times. Then there's consumer staple. These are the things we buy no matter what, like food, soap, and toilet paper. Procter & Gamble, Coca-Cola, Walmart, way more stable because, let's be honest, we all need groceries and toilet paper. Number 6, energy. Oil, gas, renewables are all part of energy sector. Companies like ExxonMobil, Chevron, NextEra Energy are some of the examples of this sector. These can go up or down based on world events or oil prices. Number 7 is utilities. Power, water, and electricity companies. Think Duke Energy or Hydro One. People need utilities year-round, so these are often considered safe. 8, industrials. Construction, shipping, aerospace, and machinery. Boeing, Caterpillar, FedEx. These do best when economies are booming. And number 9 is real estate. Companies that own or manage properties, these are called REITs. Some of the examples are Prologis or Realty Income. They often pay investors regular income through dividends. 10, communication services. TV, internet, and social media companies are part of this sector. Examples can be Meta, that's Facebook, Netflix, Google. These are big players in entertainment and they control our lives on a daily basis. And finally, materials. Companies making raw stuff, steel, gold, chemicals, like DuPont or Barrick Gold. They're super important for all kinds of industries. So why do sectors matter? Here's the deal. If all your stocks are in tech and tech sector crashes, your whole portfolio crashes. But if you spread out across different sectors, your risk goes down. That's called diversification. Tech might grow fast. Staples might stay steady. Healthcare protects during recessions. Mixing sectors makes you a smart investor. Now you know the 11 major stock sectors and why they're important for your investing journey. Hit like if you learned something new and subscribe for more money and investing tips right here on Kids 2 Grownups Finance. Until next time, build smart, invest smarter.